Lecture 5, Natural Resources, which takes us into the bigger picture again. And I did this, and I want to talk about this again, because we had this at the very top of the semester. We're starting to, I'd imagine you guys, less so, because I don't have to sit in the exam. I'd imagine you guys are starting to think about exams coming up, which, again, can be a somewhat stressful situation. But I wanted to take a small step back, partly because of exams coming up, and partly because of the nature of what we're doing this week, and how it relates, and how we can relate it to some of these ideas which we saw at the top. So the first thing is around information. Accounting is information. Accounting provides information in a certain way. It provides certain sorts of information. What you guys need to be starting to think about, and as you start looking through, especially the front, sort of the questions around week 1 type material, is how do people use information? And specifically, how do people use accounting information? Now, what also becomes important, and we started to see that last week in relation to intangible assets, is that there are intangible assets which are recognized, but there are also a lot of information, a lot of useful information, which is not put in the financial statements. And you guys now have an awareness of that in relation to intangible assets. You're aware of the brand names, when they can get brought on, when they can't. You're aware of how these things are dealt with. What we're going to be looking at today is around 2 different sets of issues, which, knowing how information gets provided, we're going to be looking at natural resources, and specifically a big part of that is the value of the thing that you find. So we're going to look at how that gets embedded, or potentially doesn't get embedded, within the financial statements. When we move to agriculture, a big thing around that is when profits get made in relation to agricultural activity. Because again, it is somewhat different to what we've seen before. You guys need to start thinking about how that relates to incentives. So we know information gets used. We know that's the case. What you need to start tying it into is, well, how does that incentivize, how does that use of information incentivize management to potentially adjust what they portray to outside users? Think about it from a profit point of view. Think about it from an asset point of view. Think about it from next week when we start looking at it from liabilities, from a liability point of view. And then also the regulation and how the regulation deals with that. Now, an example, very quickly. Think about asset revaluations. Now, asset revaluation, the revaluation model, allows a company to use fair value of an asset. So if you have a piece of land you bought for $1 million and it happens to be worth $5, you take it all the way down. If that fair value of the land happens to be worth $100 million, you take it all the way up. So they allow to move the asset up and down. And so there are going to be incentives around just the actual value of the asset. But think about it from a profitability point of view. The regulation allows you to go both ways. But if you're bringing that asset value down, you have to take it as a hit to profit. You take it as a loss. But you don't get to do that if you're going up. If you're going up, you don't get a profit surge. You don't get it coming through profit in that direction. It bypasses profit and goes through to OCI. And that's the regulators trying to stop one of the motivations around opportunistic asset revaluations. Because if there's no profit effect from pushing an asset up, it takes away one of the motivations for management to push these revaluations. And that's regulation dealing, I suppose, solving some of that problem. Right, topic overview. From here on in, the topic overviews will change slightly, because we're starting to look at specific issues. With the exception of next week, which is an introduction to liabilities, we're going to be looking at natural resources. Then we're going to look at foreign currency in a couple of weeks' time. We're going to look at financial instruments, leases, tax, and so on. We're looking at some specific things here. We're looking at exploration expenditure and agricultural activities. The thing is, to be something worthwhile talking about, which is what we're doing. If this wasn't something of interest, and I hope to convey the message that this is actually something interesting and it is something topical. If this was not something that had an economic impact, we wouldn't need to talk about it. If this was something where it didn't matter how you chose or what you dealt with it, the accounting would be the same, there would be really no point talking about it. It would just be, this is the way you do it, and that's it. But the issue around natural resources, both agriculture and mining costs, are that economically they're important. If it was just one company somewhere in the corner of the country having to deal with this issue, we probably wouldn't worry. But the fact is, these are substantial issues from an economic point of view, and the accounting will look very different depending on how you dealt with it. So they are important things to look at. Where we're going to go is to look specifically at AASB 6, so around exploration and evaluation of mineral resources, and AASB 141 agriculture. Now, apart from the fact that they're both sort of natural things, the reason we also look at these jointly is that they actually have a very different basis for the accounting. And we're going to explore what that difference is and why that's important. All right. If you ever happen to look and do sort of a cut of the companies on the ASX, and granted, a lot of these are small companies, so I'd imagine that's percentage of companies. If you did it sort of size weighted, it may not necessarily be 50%, because a lot of the very, very small companies on the ASX are mining and sort of exploration companies. But 50% or nearly 50% of the companies listed on the ASX are in the materials or energy sector. It is an important part of it's an important part of listed companies. And if you haven't been living with your head under a rock for the last few years, you'll notice that mining to Australia, especially WA, has been a massively important thing for the country. You could argue that we would have gone into recession ages ago had it not been for the strength of the mining sector. Now, that's coming off a little bit now. But back in 2010, 2011, which is the last year I could get stats for, mining was about 55% of total exports. It's a big deal. What we're going to be looking at is two things: how we deal with the money that we spend in relation to mining, and how we deal with what we actually find. So AASB 6, exploration for and evaluation of mineral resources. The first thing to note, and this is actually quite an important thing, is AASB 6 is a really small standard. There's actually not a lot going on in it. And the thing is, it's not a standard which is an industry standard. It's not like, here BHP, here's AASB 6, and that you can deal with everything. AASB 6 literally just deals with the money that you spend looking for things. Going out into the outback and drilling holes and blowing stuff up and however else you find whatever they're looking for. Once you've found something, all these other standards kick in. Once you start the development processes, the extraction processes, then other things occur. And we will step through all of that in the examples today. Okay, the first thing we need to have a look at, and this sets the scene for the rest of it, is what an area of interest is. An area of interest is an individual geological area which is considered to constitute a favourable environment for the presence of a mineral deposit or an oil or natural gas field, or has been proved to contain such a deposit or field. That's Australia. And we can't forget Tasmania because they get awfully upset when you do. Now, when we're talking about individual geological areas, we're not going to be the ones defining that. We'll just say, look, there's the different geological areas, because realistically, we don't have the expertise. Maybe you do, I don't know. You never know who you've got in the audience. We don't have the expertise to be able to define or determine what these are. But as you can see, they could be argued to be a bit loose. But let's just say we have an area up in Queensland, an area in New South Wales somewhere, and an area in WA. Those all get dealt with. The money that you spend in those areas gets dealt with differently. Well, sorry, not differently, gets dealt with separately. So if we spend $1 million up here, we spend $2 million over here, and we spend $4 million over here, we've spent in total $7 million. Now, there is an important reason why we deal with them separately, and we're going to see that as we step through. But the important thing is areas of interest do not get, you don't just roll all that spend in and just deal with it together. You deal with it on a separate individual geological area basis. So for each area of interest, so we had the one in Queensland, the one in New South Wales, the one in WA. For each area of interest, expenditures incurred in the exploration for and evaluation of shall be expensed or capitalized, which is actually pretty loose when you consider it. Can I get rid of that? No. That's going to look messy. Well, it is actually an asset, but I'll use a proper asset. So we're going to credit cash. Let's just argue we're spending cash, we credit cash. And that's just saying paragraph AASB 6 AUS 7.1, and I'll talk about the AUS in a second. That's just saying we are the debit asset or debit expense, which is pretty much all you can do anyway. And you have choice about what you can do. So debit expense or we debit asset. Now the thing I just want to touch on quickly, and this is a general comment, is about what this AUS represents. Now for some that came to the drop-in a few weeks ago, we talked about this. But what this AUS means is it is an Australian specific paragraph. If you looked up the international version of 6, you wouldn't see that in there. That is something which the AASB has included in the standard. You'll also see, if you're reading through the standards, you'll see sections where it says deleted by either the IASB or deleted by the AASB. So if it's deleted by the AASB has taken out that paragraph. And if you think about that from a more general basis, if Australia is deleting and inserting paragraphs, what's to say other countries aren't doing the same? And if other countries are doing the same, how can we say there's true comparability across all the standards when people are adding and taking things out? Now, they're not major additions or subtractions from it, but it's something to be aware of that you may see some differences taking place. Okay, you can only, this is for the capitalization. Yep, that's right. Okay, so for capitalization, you have to have these conditions being met. Firstly, you've got to be allowed to be in that area. So you have to have rights to tenure. Because you can't just go around out in the middle of the outback and start digging stuff up. You need to be allowed to be in this area. You need to have rights to be in there. So that's an important thing. We're going to assume that's the case. We're going to assume that wherever we're looking in these situations, we do have the rights to be in there. And you need at least one of the two following things to be taking place. One of them is not that controversial. The other one, when we start to compare it to something that we did last week, starts to look a little bit, funny is one word, inconsistent might be another. And I just want you guys to start to think about this at a critical level. Okay, so the first one, I don't think there's much problem with this. The exploration and evaluation expenditures are expected to be recouped through successful development and exploitation of the area of interest. Okay, successful development. You expect this to work for you. Now start thinking about what an asset is from a conceptual point of view. We expect to get future economic benefit. We spent money in this place. We expect to get something on it. That seems to be we're going to get some sort of benefit. That to me makes a lot of sense. It's the next one which, and it's not just me that just finds the next a little bit inconsistent or strange, but I mean certainly colleagues and people I've talked to about this. Exploration and evaluation activities in the area of interest. We are talking about here being able to capitalize something in the area of interest have not at the end of the reporting period reached a stage which permits a reasonable assessment of the existence or otherwise of economically recoverable reserves. What that is effectively saying is you have no idea. It's not like you say we absolutely categorically know there's nothing there. It's like when you've lost your house keys or your car keys in the house somewhere. they may be there, who knows, but you've got to look around for them, and you've not searched every single nook and cranny in the place, behind the cupboards, under the couch. You still aren't 100% sure if anything's there or not. They could have gone somewhere else. And that's what's happening here, is you just don't know. Now, the thing I want you to link that back to and think about in comparison is, how does this relate to what happens with research spend? When we looked at AASB 138 last week on research and development, you spend money on research, which is trying to find new technology or new breakthroughs or whatever it happens to be. Under that is seen as something which you cannot capitalize, because the probability of success is so far out, they say you can't. How is research different from going out and drilling holes in the middle of the outback? Because that, you're searching for something, and you don't know if you're going to find something, but yet you're allowed to capitalize that. So it's actually what I would consider two very similar situations being treated very differently. Now, arguably that's inconsistent, but I mean, that's the way some of the regulation and standard setting goes. You are going to find inconsistencies. Now, I don't know the full historical background behind the development of AASB 6 and the international version, but from what I've been, not led to believe, but from what I've understand of it, there was a fair bit of lobbying pressure being placed around the development of the standard. So that may be why that's part of it has come in. But anyway, it's just something to be aware of. Okay. Exploration and valuation assets are measured at cost at recognition. Now, importantly, exploration and valuation assets, those aren't the things you're looking for. Those aren't the gold or the oil or whatever it happens to be. That is just the things that you've spent looking for it. We're not even talking about the resource at this point. We're just talking about the money that you've spent. The money that you spent gets measured at cost, and you classify that spend based on whether it's tangible or intangible based on what you spent it on. So if you spent money on geologists, you would have that. If you're going to capitalize them, those aren't a tangible asset. It's a service cost that's happened, so those would be an intangible exploration cost. If you bought machinery and you're using machinery to go and do the things you need to do to find the minerals, then that would be a tangible asset. So we'll give you guidance as to when it comes to practical questions about whether it's tangible or intangible, but that's something to be aware of. Okay, let's say we find something. So paragraph 17 deals with the situation when you have found something. So an exploration and evaluation asset shall no longer be classified as such when the technical feasibility and commercial viability of extracting a mineral resource are demonstrable. What that is saying is, yes, you found something, and if at that point you had an asset on the books, you no longer classify it that way. So what we're actually doing here is we're just turning it from an exploration and evaluation asset into some other type of asset. And you'll see that in example as we go through it. So you still have an asset there, you're just changing the nature of the asset. If you don't find anything, paragraph 18 deals with failure. Exploration and evaluation assets shall be assessed for impairment when facts and circumstances suggest that the carrying amount of an exploration and evaluation asset may exceed its recoverable amount. So we have an impairment, and the carrying amount of what you've spent shall exceed your recoverable amount. Now the thing is, you've spent money. So if you spend $1 million searching for oil somewhere, you're going to have, and if you've capitalized it, you'll have $1 million asset on your books. But if you figure out that there's nothing there, like you've searched and there's nothing there at all, there's no value from holding that bean in that area. Like, you're not going to make any money off it. So the recoverable amount of bean there is zero, because you're not going to do anything. So you've got this $1 million asset that you spent trying to look for this thing, and the recoverable amount's zero. You have an impairment, and you'll just write it down. So that's what happens if you have a failure. And if you look towards the paragraphs after 618, it actually goes into some detail about that sort of issue. Where's the pen? There it is. Okay, but importantly, the actual resource itself, the thing that you're looking for, and if you happen to find it, so this thing down here, that's, that looks pretty big, it's probably worth a fair bit of money. That never turns up on the financial statements. And that's an important thing. If you're looking at mining, or if you're especially junior exploration companies who basically have no assets and what they're trying to do is find something, the value of that company is not going to be shown by the financial statements. And just to reiterate that point, I just want to show you an example of a company. Some of you may have heard of this company, Fortescue Metals. What I've done is extract from the Morningstar Data Analysis Premium database, which is available on the library website. And this is their annual profit, annual net profit, each year for the last 10 years. And what you'll notice is in the first 4 years of that period of time, they were not making much profit. In fact, they actually lost a hell of a lot of money in 2008. Their loss was something like $2.5 billion. So that's a substantial amount of money to lose. Now, normally for an industrial type company, or for most companies that you'd imagine, if you see a loss in the magnitude of $2.5 billion, which direction do you reckon share price would be going? Yeah, you'd expect it to be going down. Now, obviously, the fact that I'm talking about this tends to suggest that's not what happened, and you'd be right. Share price actually went completely the other way. Share price rose from basically cents, went massively high. Now, the thing is, this drop is actually partly a mechanical drop because they had a 10-for-1 share split. So that's actually not quite what's happened. You don't see that drop in reality. As they're losing money, share price is going through the roof. Why? Why do you think that would be happening?
Because the shareholders say that they're spending so much on investment.
They're spending money on investment. This is a mining exploration type company. They're spending, and that's partly to do with it. What is it about exploration companies which is important? What's going to make them money? Yeah, is that? They're drilling heaps and they find something. That is exactly what happened. They started to find stuff and they found a hell of a lot of it. That is what is valuable. The thing is, when you find whatever it is that they're looking for, in this case iron ore, that is not going to be put on the books. You will not open up a balance sheet and see that information in a balance sheet. So again, from an information perspective, not everything which is valuable to a company, not everything which is valuable to outside users is actually going to be contained in the financial statements. And even though, I'm an accountant, I don't have a problem with that. Like, you can never capture everything fully within them. It's just for you guys to be aware that that's actually what's going on. So, yeah, there's a big run up. Obviously arguably that's also, GFC was sort of going around at this point, but there was a stock split which dramatically changed the price at that point. In terms of the actual resource itself, and I'll see if I can get this article up online. This was from a week ago. Actually, not even that long ago, the 20th. No palliative for iron ore price pain. Now, what I pulled out here, and this is another argument, arguably, as to why iron ore, well, not just iron ore, but commodity prices shouldn't necessarily be embedded within the financial statements, is in the red line, what we have is the Australian US dollar exchange rate, and we have the iron ore price for the US dollar price for iron ore per ton in the blue. Now, firstly, I just want to talk about the blue, and then we'll talk a little bit about the red, and we'll talk about a little bit about them all together. So the blue line hit over, in about end of 2007, it was over $200 a ton. About a year later, it was down to about $60 a ton. 2011, 2010, 11, it peaked in recent times at about $180 a tonne. We are now staring down a situation where it's going to go through $55 a tonne. Main point is it's volatile. Now, if you have billions of tonnes of this stuff that you found, that's going to be throwing your balance sheet all over the place if you're actually capitalizing that. So that's, I suppose, one argument is the volatility in some of these is going to throw your balance sheet all over the place. And that's going to make your balance sheet and the financials kind of pointless. The other thing is, if you get disclosures about the amount of information about what these miners and exploration companies have found, and they do disclose this information, you can then, as an analyst, start looking at, we know they have X amount of X amount of Y quality. We know spot prices or whatever they are. We have ideas of what future price is going to be. We can start to build in what we think the value of this is. So you're able to do a lot of that based purely on the amount and quality of what they've got. For 2 weeks' time, and this is a nice graph to just start to pick this up, the Aussie dollar is also pretty volatile. It was about 80 cents, so a little bit under parity back in the mid-2000s, almost hit parity early 2008, and I know this happened because I was in the US just as this started happening. It went from close to parity down to about 60 cents, which if you consider that as an actual percentage drop is massive. I left the US just as it started coming off its peak, came back, and about 2 weeks later was down at 60, which, you know, luckily for me, I missed that, but that's a big drop if you've got trade going on with international partners. It's come back up, and we're now trading down in this range. We're going to be looking at how to deal with foreign currency fluctuations in 2 weeks' time. So that is something that we'll be looking at. You guys have done business statistics, correct? Yes. Yep. Okay. You guys do correlations in business statistics? Correl what? Okay. But you calculate correlations, you kind of know what, you know, I'm not asking you to calculate something right now. Do those look correlated? Now, we're not that that's a spurious correlation, but there does look to be some correlation between the Aussie dollar price, the US Aussie dollar exchange rate and iron ore prices, but it could be completely spurious, we don't know. On a complete side note, there's actually a really good website about spurious correlations, which I'll see if I can dig up, because it relates one thing to completely pointless other things, which may have been a completely pointless piece of information, but nonetheless. This is from yesterday. What's today's date? 26th? Yeah, this is from yesterday. Impex, which is a Japanese company, writes down value of Timor Sea field. Deteriorating market environments resulted in the recognition of impairment losses. The thing is, they're not writing down... Nicholas. Yeah, good. How are you?
Sorry for intruding.
That's all right. It's a pleasure to have you here.
Thank you.
They're not in this case, and I know sort of going in a bit of detail, they are not impairing what they found. What they are impairing is the exploration and the development assets around the sort of the infrastructure around the dig site and what they're doing. So again, these do have impacts on balance sheets, and because of the way commodity prices are going at the moment, you're seeing impairments and things taking place all around the world. Which takes us into, if you guys have, I realize this may be a little bit small, but if you guys have the example sheets with you, this is for you guys to follow along. So we're going to do this in a few phases. The first bit is we're going to look at the AASB 6 section, which is this bit. So we have one company, Palmer Mining. Pick who I was thinking about when I started looking at this. Palmer Mining incurs the following expenditure looking for gold in 2 sites, one in WA and the other in Queensland. And I need to talk about why it's important that we do these separately in a second. And we'll do that in a moment. So they're looking in 2 sites. In this year, they spend 4,500, 9,500, which equals... They spent 14,000 in the first year looking in 2 different areas. They spent 13,000 in the second year looking in those 2 different areas. And they spent 11,500 in the third year. So this is actually cash going out of their business in each of those years. If we want to get the total of these, I hope I can add these up. In total in WA, over those 3 years, you have spent $18,000 searching to find something. And over those 3 years in Queensland, you have spent $20,500. So when we see some of the numbers, which we'll see on the next page, or if you've got it in front of you, just lower down, that's how those numbers came about. At the end of 2012, Palmer Mining has determined there is gold in economically recoverable amounts in WA, whilst also determining there is no gold in the Queensland site. So WA, happy days, we found something, and that we figure out at this point. In Queensland, there is nothing. And again, we figure that out at this point too. 2010, we don't know. We're still looking. 2011, we don't know, we're still looking. It's only at 2012, when you get to the end of it, that you go, happy days, we've got something, and no, we don't. And that's going to drive what we do for the next little bit. Now the thing is, as you'll start to see, because there are questions on this, you can see from the mid-semesters, unless we tell you they do it this way or that, you actually get complete choice about which you get to do. If you want to do it capitalized, do it capitalized. If you want to do it expense, do it expense. So this is, the standard allows a choice, and it's either this way or this way. So you don't have to do both, you just do one or the other. Now what you'll see is the cash, credit cash in each of these is the same. So the credit cash, regardless of capitalized or expense, is going to be the same. You've got that much money going out. As we just saw, 14,000, 13,000, 11.5. If we choose to capitalize, it's best to separate them out. So you've got WA and Queensland, and you just pick out for each of those years, and you've got the information in front of you. You just go, an asset, we spent $4,500 in WA, so we have an asset for WA of $4,500. You then spend $9,500 in Queensland, you have $9,500. Repeat, repeat, and this takes us to the next little bit. If we have expensing, I mean, if you really wanted to, you could do it as WA in Queensland, but it doesn't really matter. Main thing is if you're expensing this, just debit expense, whatever it is, debit expense, whatever it is, debit expense, whatever it is. That's all you have to do. Okay. So now what we have is a situation where we have found something in WA. So we found something in WA, and if you remember, WA had 18,000, and Queensland, which we had nothing, was 20.5. This paragraph, this journal entry is where we found something, and it's paragraph 17 coming into action, because you're taking this asset, the exploration and valuation asset, and you're reclassifying it. So you're taking that exploration asset, you found something, paragraph 17 says you can't have it anymore, as you've got to reclassify it as something else, bless you, and you take it into assets under construction. So you're in the middle of turning it into something else. Where you've lost something, or you haven't found something, I should say, not lost it. Thought I lost my car keys the other day, and God, it panics you. Paragraph 18 is when you have an impairment test, because in this case, we've figured out there is nothing there. It's not like we're still looking, there may be something, there ain't anything going on. We do an impairment test, we're assuming that would give us a zero recoverable amount, and we have an impairment loss. So in both cases, we're getting rid of the E&E asset. In this case, we're turning it, reclassifying it into another asset. In this case, it's a loss. Upshot of all of that, we end up with getting carried forward $18,000 of assets. So that's the thing, because we're going to need it for the next page or the next section. Once all this is done, we've capitalized, reclassified, impairment test, got rid of, we end up with an $18,000 asset. That's the important thing. Now, before we get into the development phase, let's get into the expense cost. The thing is, you have no assets. They've all been expensed out. There's like nothing on your balance sheet. So there's nothing to reclassify. You don't have to do anything. And there's nothing to impair because it never came onto your books as an asset in the first place. So it's gone. It never happened in the first place. So you don't need to do anything. So in some sense, doing the expensing route is actually a much easier way to deal with it, because it's just debit, expense, debit, expense, debit, expense. Kind of that's it. And what this whole thing, this is AASB 6 from start to finish. Once we've moved from this phase, we're moving into other standards, and we'll look at the extraction and development, sorry, the development, extraction, and selling phase in a moment. But that's it. That's a sum total of what you need to be across for AASB 6. The one comment I just want to make is around areas of interest. And I think if I come back, we've got more space here. So let's showcase my amazing drawing skills. Doop. I need to make sure I do that. I've got a colleague from Tasmania, and he gets really upset when we make fun of him. If anyone's from Tasmania, sorry. Take that as you want. So that's Queensland. Sorry, my geography is being thrown by my incredible drawing. We're just talking about why area of interest and doing them separately is important. So we use what's called the area of interest method. This is the only method that you're allowed to do under this standard. It's just the area of interest method. Now what it means is, you spent money over here, you define and you deal with those areas and the success and failure of them separately. So if in this case, if you're capitalizing, in this case WA is successful and Queensland isn't, you keep this 18,000 and you get rid of that one. So even though that you've spent 38,500, only 18,000, if you capitalize to begin with, actually keeps rolling on. In the areas where things have failed, you get rid of it. Now, why this is important is there is another method which isn't allowable, but you'll see it if you look at your textbook, they talk about it. It's called the full cost method. And what that's basically saying is, we don't just look at these as separate things, we look at this in totality. So we have spent $38,500 looking everywhere for stuff. As long as we find something somewhere, as long as we are keeping looking somewhere, we can roll all of that as an asset. So it actually shields, if you think about it, that shields situations where you've gone and looked somewhere and you haven't found something, because that will actually be shielded within this amount here. So it's a much more conservative option by looking at it on an individual basis. If you think about an analogy to that, it's a similar sort of thing to inventory write-downs. Inventory write-downs, you try to look at them item by item. So it's not different setting, but same sort of idea. Bless you. Okay, so we've done with the, bless you. Okay, that's really small, but again, you guys have got a copy of it. Okay, so at the end of 2012, Palmer has determined there is golden economically recoverable amounts at the Western Australian site. No gold in Queensland. Following the discovery, roads and other infrastructure are constructed at $12,000. So we've gone, I'll write this up a little bit bigger if I can find it. So we put in infrastructure, roads and the like for 12,000, cheap roads. Portable buildings, incredibly cheap buildings. In portable buildings with a life of 8 years are also put in place at a cost of $1,600. Production begins in 2012. Is envisaged that the Western Australian site contains 250, I'll just call them units. Incremental costs of production are, production equals $3.50 a unit. It is envisaged 250, incremental costs of production are $3.50 per unit. During 2012, this is extraction. You extract 40 and you sell 30 at 150 a unit. Okay. So that's the additional information we've got. We've got some more development information around how much we spend setting the site up. We've got some extraction information. We've got how much is in there, 250, how much we extract and how much we sell. So that's all I've done is restate the information that was provided in the question. Now again, I'm going to focus on the left-hand side because it's the right-hand side will then flow really easily from that. If you remember, we had the $18,000 in assets under construction. We've turned that into property, plant, and equipment. You may see in examples it's mixed between property, plant, and equipment and intangible assets. Realistically, it's not going to make that much of a difference to us. We just call it property, plant, and equipment here. Okay, so the development section, which is all of this. This is the money that we spent on infrastructure, the 12,000. The money we spent on buildings, which was the 1,600, and that means in total, this plus this gives you the 13,600. That's all that we've done there. And that's your development phase done. Okay, the next bit is your extraction phase. What we're digging up, I have no idea what gold looks like in the ground, but we're digging up gold out of the ground and it's now inventory on top of the ground, somewhere in a warehouse or wherever they store them. AASB 102, inventory, 2 weeks ago. What gets included in the cost of inventory? General idea. Doesn't have to be word perfect, doesn't even have to be close to word perfect. What is the idea about the valuation, the cost of an asset? Think about my running shoes. You can remember them? Yes? Yeah, so it's everything that you need to spend to... Yeah, so all the acquisition costs, shipping costs, all of that. So there's an idea behind it. We need to, everything that we spend to do something with that asset. To get it, I suppose to get it to where you want to utilize it, to get it ready in the sort of space, to get it ready in, lost words, to get it ready so you can use it. Yes, so utilization is probably a good, much easier way to do it. Condition, that's the word. Commission. So
you commission the...
just go with condition, that was actually really spot on.
The operating stage. Okay.
Yeah. No, I mean, yes, sort of commission, but condition was actually, I think, the word I was trying to think of, which is completely different to utilization. Same sort of idea. To get it where you want to use it. To get gold out to where we want to use it, first thing we need to do is we need to find the stuff. We can't really get it out and ready for use if we don't know where it is, so we need to find it. So the money that you spend finding it actually gets embedded in part in the cost of the inventory. You need to dig it up, so any production costs. You have infrastructure costs get the accumulated depreciation. If you remember back a couple of weeks ago, we talked about accumulated depreciation. normally gets expensed out unless it can get included in the carrying value of another asset. That's what's happening here. These buildings and property, plant, and equipment are being depreciated, and that's not being expensed. It is being put into the carrying value of that inventory. What we see here is a cost system for the inventory. So this number here, this 5140, is not an intrinsic value of that gold. All that 5140 is the accumulated cost used to get that gold out of the ground to where we want to use it. Nothing to do with the valuation of the inventory. We'll talk about how we get the 48, the 2, and the 140 in a second, but that's all we've done. The inventory is literally a calculated number. We're just adding up all the things that we do to spend to get it. That's it. Property, plant, and equipment. I'm going to have room. Let's see. Is the 30,000. 30,000 comes from the 12,000 here and the 18,000 from the exploration cost. Divided by 250. There are 250 units you expect to be able to extract. That is kind of the production, the number of units that you're going to produce. So that 30,000 gets allocated across the 250. In that year, you extract 40. So I'm pretty sure if you run that through with the calculator, that's going to give you $120 a unit. You multiply it by 40 units, that's going to give you 4,800. The buildings, though, are a different matter because the buildings are portable. Roads and stuff, I'm pretty sure you can't, again, I'm not an engineer, so maybe you could. I'm pretty sure for these sort of things, you can't just dig up a road and move it somewhere else. It's there, it's set up, the money's been spent. The buildings, on the other hand, are portable. They could be used somewhere else. You've only used them for 1 year. Let's say that it is the whole year. So that is a 1,600 divided by the useful life times by 1 year. So it's a 1,600 divided by 8 years multiplied by 1 year gives us 200. And lastly, production costs. So this is your labor costs, marginal electricity, all those sort of things. Production costs are $3.50 a unit times by 40 units gives you 140. Okay, so we've worked out all of these and then we allocate these costs to the inventory. That's all that we've done. And then the last little bit, we sell it. And for you guys, you've come across these lots of times before. We sell units, bless you. We sell 30 units. We sell it at $150 a unit. It's just 30 by 50. And even I don't need a calculator to figure out that looks correct. So 30 by 50 gives you the 4.5. For the cost of goods sold, we have total inventory of 5140, but that is for 40 units. But we have sold 30. So it's a 5140 divided by the 40 units, and if you want to work out the per unit cost, go for your life. But that's the per unit cost, and multiply it by the number of units sold. There we go. Let's change colors. Ink color. What's a good color? All right. Okay. Okay. If we look at it on this side, there was no asset coming through. This set of journal entries is exactly the same. So nothing changes here because that's the same phenomenon going on. This idea is the same. We're still adding up the three amounts to come up with this 2260. So this amount here, we're still adding these three things to get to this. cash is going to be the same, and the buildings are going to be the same because we still have 1,600 of buildings and it's still $3.50 of cash. The thing which changes is the accumulated depreciation for property, plant, and equipment. Because on this side we had 12,000 and 18,000, whereas on this side we only have 12,000. So it's going to be 12,000 divided by 250 times by 40. And that's the only thing that changes. The calculation, the idea behind the calculation is the same. You're still adding up these three things, but we don't have that extra $18,000 of assets for exploration because we got them off the books straight away. And if you remember back to this idea behind what happens with assets, everything at some point will go through profit and loss. You spend money on inventory. It either comes out as cost of goods sold or a write-down. You spend money on property, plant, and equipment. It comes out through an impairment loss. It comes out through, I suppose, arguably a sale in some way. Impairment loss, depreciation, or it gets embedded in another asset like inventory, which then gets written off or comes out through cost of goods. It flows through the system. So in this case, where is it? In this case, the asset never existed and it already came out through profit and loss through expense. In this case, it's going into profit and loss and then getting expensed out as you sell it through cost of goods sold. So that changes a little bit. Doesn't matter the cost structure and how you've dealt with them, the sale is going to be the same. And cost of goods sold and inventory is going to be a little bit different because we're dealing with a smaller inventory level. It's the 2260 divided by 40 times by 30. So 2260 divided by 40 times by 30 will give you 1695 as cost of goods sold. And that's all she wrote for development, extraction, and sale. So we've done AASB 6, the exploration section, on the first page, and we come into this page. The top level is development, we then have extraction, and we then have sale. That's it. So again, there are videos on this. This will be a video hopefully at some point. So if you need to go over this stuff, please do have a look at the questions in the mid-semesters. You get a sense of the types of things we can ask. Which then leads us nicely into, we've got a good amount of time to go, which then leads us nicely into agriculture. Now, (2010, 2011), look, agriculture has been pretty important for Australia. Arguably, it's going to be important going forward. One is important just for people because without agriculture, you don't have food. Without food, you have some problems. So it is important. Total exports were substantial. I mean, it's still not a massive amount of GDP, but it's still important. And I'm going to put your thinking caps on because I have a question for you guys coming up in just a moment. The importance of it, scratch that. The importance of exploration is important, but we're looking at agriculture, is how to account for living plants and animals. Because we haven't dealt with that sort of stuff before. So things like sheep. Shaun the Sheep, which opens today. And it's unfortunate I know these sort of things, but I do. Now, the question I have for you guys is, do I have space on the next slide? I do have space on the next slide. Agriculture 141, but I need to pose a question to you guys first. That's not the right color. Red's a little bit easier to see. Just in case you can't tell what that is, that's a sheep. I'm sure you all picked it. Now, the reason I draw this up is not to showcase my amazing artistic abilities. The reason I draw this up is to pose a question to you guys. Let's imagine this company is running a farm and has sheep. Not just one, has lots of them. But for this particular sheep, in its life, $200 is being spent getting it to where it currently is. Vet bills and food and shelter, I don't know. Water's probably free. You know, all the various costs that you need to keep a sheep running. I don't spend much time on the land, so forgive my ignorance on such matters. Now, this is a sheep which is being used for wool, not for meat, because that would be a slightly different scenario. Now, definitely for this sheep. So sheep, we end up with, it gets shorn, and we have wool. And we end up with a slightly cold-looking sheep. My question to you is, what we know about assets. We had mentioned utilization, condition, commission, this idea of the asset, all the costs, because we've been working on a cost model. We spend money and it gets allocated based on everything we need to get that asset ready for use. We've spent $200, if this is an asset, we spent $200 getting this asset ready for use, which is providing us wool. It has provided us wool. We now have two assets. We have a very much alive sheep, if not a little bit cold, and we have a bale of wool, or how much the sheep provides us. My question is this, AASB 102, if that wool is inventory, you're trying to sell it, which is what they're trying to do, that should have all the costs embedded in that inventory of what you use to get that wool ready. And we know what the sheep costs, but we also still have an alive sheep. And if that sheep is also an asset with cost, that $200 was also used to get that sheep still alive and still there and ready to produce more wool. So my question to you is, how much should be allocated to the wool and how much should be allocated to the sheep? I want everyone to do this, just write down for the moment, all you have to do is write down two numbers. I want you to write down what you think of that 200 should go to the wool and what you think should go to the sheep. And think about how you'd approach this. There are accounting, you know, you're all budding accountants. Is a sheep analogous to something else potentially? How would you deal with it? So literally this is just off the top of your head. 5 seconds, just write a couple of numbers down. Let's see, and let's get some discussion going on it. A lot of people are writing stuff down. A lot of people are just sort of staring and thinking about it. Now, okay, that should be time. And if you haven't written something down, you should have something in your head. Now, should the wool get all $200? Yep. No? Should the wool get $200? Just, yep. So the sheep's worth nothing.
No, sheep will make 200 as well.
So now we've created, from a $200 to spend, we've created $400 of assets. Should all the money go to the sheep and zero to the wool? So the wool's not worth anything at all. It's on our books at zero.
Creates its own new value.
And how do we come up with that new value?
Market price.
Okay, something to do with market price. Is the sheep going to live forever? Be pretty scary if it did. Sheep's not going to live forever. Is this a depreciable asset? We have a useful life. We could argue we kind of know how much wool it produces. Could it be something like that? Could we allocate based on something? I don't know. The point of it is, we could go around for this for days. The point of it is, it's actually quite complicated to think about the ways it could be done. There's a lot of subjectivity in it. You may think 50%, you may think 25%, you may think, oh, it's just being silly and this is actually nothing relevant to what we're talking about. But it is, because there are a lot of agricultural companies out there. So let's have a look at what we're doing. Agricultural activity is the management by the entity of the biological transformation and harvest of biological assets for sale or for conversion into agricultural produce or into additional biological assets. So that means just because something's alive, because you've got, where is it? Just because you've got biological assets doesn't necessarily mean it's agriculture. Agriculture is talking about transformation and harvest, which we'll define in a second. So we're thinking about picking grapes or picking apples or shearing sheep. We're doing something with it. It's talking about conversion into, so harvest of biological assets. Where's the next bit? Management of an entity of the biological transformation and harvest of biological assets for sale. Okay, sorry. For sale. So we're actually growing these things to sell off. Now, I don't know why the first thought that comes to my head are puppy farms, because they're not good things, but that's what they're doing. Conversion into agricultural produce, so shearing the sheep, you can get in agricultural produce out of it, or into additional biological assets, you're just breeding these things for breeding. Now, things which don't get included would be things like petting zoos. Those aren't any of those things. Now, again, I'm starting to get a glimpse of what the petting zoo world is like, and that's nothing to do with this. If you've got a company that has land and it has trees on it and stuff, that's not agricultural activity. So just because it's a living thing doesn't necessarily mean it's agricultural, it falls under 141. Agricultural produce is the harvested product of the entity's biological assets. So long and short of that is basically the stuff which isn't alive. So it's, wool, it's meat, milk, all those sort of things. Biological asset is a living animal or plant, so the sheep itself, the trees, that sort of thing. I just included this because I just wanted to read it out, because when you look at it, this is how you take a natural, very natural process and idea and turn it into legalese type language. So harvest is the detachment of produce from a biological asset or the cessation of a biological asset's life processes. So that last bit, cessation of a biological asset's life processes, is killing something. That's how they define that. Sounds a bit long-winded to me, but such is life. So that is some of the definitions that we've come across. Now, how to deal with it. You shall recognize a biological asset or agricultural produce when, and only when, the entity controls the asset as a result of past events, probable future economic benefits, and you can reliably measure fair value or cost. Control, probable benefits, reliable cost or fair value. We've seen those things before. So that's really not that different from assets we've come across. The next bit goes into how we value them, and you guys at the back were actually pretty close to the money. Maybe because you'd already been reading ahead, I don't know. But if you hadn't, that's pretty much what we deal with it is. So a biological asset shall be measured on initial recognition and at each reporting period at its fair value less cost to sell. So this is the living stuff. This is the tree for the apples. This is the sheep for the wool. So when you get that item, you measure it at fair value. And that makes sense because generally speaking, when you buy something, you'll be buying it at fair value. So you measure it at fair value, but then at each reporting period, as you step forward, it may change a little, the tree may grow, the land may grow up a little bit, whatever. It changes in value, and you'll pick up that change in value. We don't know exactly how we do it yet, but that will be adjusted, and you keep adjusting for it. Now, the reason this is also important is every biological asset bought that a company will have? No. How else do they get them? Breed. Yeah, they could be bred. They get born and they grow. They get created out of nothing. How do you attach a cost to that? You've just suddenly got more of them. And so this is how it deals with it, is just whatever the values of those things are, that's what you do. It doesn't matter how they came into existence. Agricultural produce, so this is the stuff which you get from the biological assets, so the apples, the wool, meat, whatever. Agricultural produce harvested from an entity's biological assets shall be measured at fair value, less cost to sell at the point of harvest. Same thing. So biological assets, fair value all the time. When you have the apple getting plucked off the tree, do you pluck an apple off the tree? I don't know. When you shear the sheep, at that point, you take the fair value of whatever that inventory is, and that becomes its cost. Now, what's also important is this next little bit down the bottom. That point in time, it becomes inventory, and then that becomes its cost for AASB 102. And from that point on, it's just inventory under 102. It rolls forward at lower of cost and net realizable value. So agricultural measurement we've done. gains and losses. A gain or loss arising on initial recognition of a biological asset at fair value less cost to sell, and from a change in fair value less cost to sell, shall be included in profit or loss for the period. So what we have here is any change which takes place goes into profit or loss. Those things happen to be worth a hell of a lot more, you get a gain on it. They happen to be worth less, you take a loss on it. This is a fair value standard. Now, the reason I bring this up is we actually see an example of this, and this is probably going to have an effect on the downside, but I also remember, and the reason I remember, personally, I like bananas. I think they're great food. Now, if you remember back a few years ago, and I do remember this because it was when UTS, the City to Surf, they actually have a marquee and you can join the City to Surf team, and basically at the end of it, so I did it in 2011, and there's beers at the end, which I don't know. I mean, after running a race early in the morning, maybe not the best thing, but there's beers, there's a massage. But the thing I do remember, and this is going back, is they had bananas there, which were awesome because that was the year when bananas were like $10 a kilo. And, I just didn't touch bananas for about 6 months, but, you could get them and they were free and basically took a whole bunch home. But right at the moment, this is from 2 weeks ago, there is potentially a problem with the Australian banana industry because there's been confirmation that there is a tropical disease, tropical race 4, Panama disease, tropical race 4, is confirmed up in North Queensland, and the banana industry is worth about $600 million a year in the country. Now, if that affects the value of these plantations, that is going to be taken as loss through their profit and loss statements. Now, agricultural produce, a gain or loss arising on initial recognition. That is the only time you deal with this because after initial recognition, it becomes inventory. And we're going to talk about this in the example in a second. It's all taken through profit or loss. So this is very much, where is it? A fair value standard. We're not building cost into this inventory. What we're doing is looking at the value of the inventory, and that's what we do. Okay, again, a little bit small, but you have, or you should have, the example with you. And I'll read it out in any event. As you'll start to see, there's very similar questions to this if you're going to do practical questions. We don't have the sale in this case, which you probably will have to deal with the sale for your guys' situations. But apart from adding a sale in, this is the type of question you can see. So Weak Arrow Limited grows apples, which is sold to local cider producers. I obviously wrote this example when cider was starting to become a big thing. On the 1st of January 2014, Weak Arrow Limited's apple trees had a fair value of $750. During the year ended 31st of December, $24,000 was spent on fertilizers. Apples with a market value of $155,000 were harvested at a cost of $21,000. Sales commissions of $8.5 would be paid on the sale of apples. And at the end of the year, the trees had a fair value of $770,000. So let's just put in some of what's going on. And I'm going to use T accounts because they actually pick up this idea much better than formula or just writing numbers in. So trees, and let's call it inventory. So the trees we know start the year at 750. And we know at the end of the year, so that's given information. You can't really do this without that. So you know they start at 750, they end at 770. The inventory, you have to be told what its value is, although in this case you've got to compute it, because it's not just the market value, which is the 155, it's the fair value less cost to sell. This is what the 850, the 8,500 is, because this hasn't actually been paid yet. This is what would be paid. So what goes down here is 155 minus, where is it? Okay, so 155 is the market value. The 8,500 is the expected selling cost. So the fair value less cost to sell is 146,500. So we know the inventory finishes at 146,500. And in relation to that inventory, it starts at 0. So those are the two asset accounts that we have. We've got the biological assets and we've got the agricultural produce, which is the inventory. The other information that we have is, where is it? 24,000 on fertilizers, and we have 21,000 on harvest. So those are cash expenses that we've had. So in terms of, and actually, we've got a little bit of time. The thing I'd also stress with this, as we start to go through these examples, for this and for the ones that we've been through, and also as we start moving forward, is there's a really important part to this. And this is, and I should have actually discussed this earlier. The key thing with this subject when it comes to doing these sort of practical examples is, one, practice. That's going to help. But I actually think one of the biggest things is just getting your head around, not the accounting, is just getting your head around actually figuring out what is going on in reality. Because if you can figure out actually the events that are taking place, then doing the sort of transaction analysis, bless you, and figuring out how to deal with that becomes so much simpler. With these sort of examples may not necessarily be too hard, but when we start getting into finance leases, and when we start getting into hedging arrangements, actually getting your head around the thing which is going on, if you can understand that, the accounting is actually very simple. So what we've had happen here is we've got an asset, a biological asset, which has just changed in value. We've not added anything to it, we've not really done anything to it, it's just changed in value slightly. We've picked a whole bunch of apples which are now on our balance sheet. And we've spent money on fertilizer and harvest costs. We've spent $45,000 and we've got two other assets which are sitting there. That's all that's happened. We've just got to figure out how to account for it. And for this, you can actually deal with these in many ways because it doesn't matter. For this example, I'm just going to expense them out. But you could capitalize them against the trees. You could put them in a whole range, different bunches of places, and it doesn't make a difference. You'll still end up with the same profit outcome and the same asset outcome. So if we expense these out, expenses, we've talked about those two amounts. We've got cash of $45,000. Inventory goes from 0 to 146,500. So we debit inventory that amount. We credit. Now I had revenue in your sheets, but I think some sort of fair value gain fits better because we've gone from 0 to 146,500. And the apple trees have gone from 750 to 770. So we've gone up by 20. That's all that we've done. If you then go off and sell the assets, so be it, but you can go off and do that. But I want you to just focus on this for a second. I want you also to cast your mind back to two different points in time. Firstly, at the top of today's lecture where we talked about information. Secondly, I want you to cast your mind back to week 2, and we had that flow chart, or not flow chart, the cycle showing when you could recognize revenue, or when you could recognize sort of profit. Think about this for a second. What has this company done? It's got $146,500 in gain. Have they sold anything? No. They haven't sold a single thing. What have they done? That's not a trick question. What have they done?
Harvest.
Yeah, they've literally picked trees, picked apples off trees. Not plucked, it's picked. They picked apples off trees. And because of that, they get a profit from it. They haven't sold anything at this point in time. Now, that is just the way fair value accounting works.
Would you say they've capitalised their biological asset?
I mean, to an extent, they've capitalised. I mean, the biological asset is the trees. They've capitalised the inventory, so the agricultural produce. So they have capitalised it, but they would be capitalising inventory. If you had bought inventory, you'd be capitalising. What's the interesting part is, so you'll still be debiting inventory. It's what you're doing with the credit. Because if you bought inventory or you made it, you'll be crediting cash or the work, the various materials that go into it. But we're not doing that. We're just going, here's this inventory that we've made or sort of grown. We picked it and we get a gain on it. And so this is an awareness when you're looking at agricultural type companies is when the gains happen, don't actually necessarily relate to sales. It relates to when the harvest takes place. Now that may not be that much of an issue. Think also about why it may not be that much of a problem, because it also might not be. But it is something to be aware of. So to wrap things up, just to also put get your head around it. So if we have, going back to chickens for some reason, we have a biological asset, it may be born. We didn't pay for this, it just kind of happened. That will change in value. I'm assuming it goes up in value, although those things probably keep you up at night. These things are all cute and fluffy, so I don't know which is valued more, but let's say the rooster is valued more. You'll recognize that change in profit and loss. Now I'll probably use the wrong, Now the next bit becomes important because the next bit, it's actually a really important point in time. It's important for the chicken, it's important for the accountants. It's important for the chicken for obvious reasons. It's important for the accountants because it changes from a biological asset to agricultural produce, and at that point, it is inventory, and it gets dealt with under AASB 102. That could get sold as is, or it could get put into other types of products and get embedded in that cost. And that takes us to 7:30 and probably dinner time if you are hungry. Anyway.
Those slides up.
What's that? You shouldn't.
Those slides up, you're making us all hungry.
That makes you hungry? Yeah, well. Yeah, I don't. Anyway. Okay, very final point, and then we'll finish it up. Biological assets for fair value issues. If you can't work out fair value, if you do, then you measure it at cost, and then you change if you can. If fair value can be determined, then you just keep doing it. For agricultural produce, you assume that there is always going to be fair value available because that's the reason you're making this stuff and growing this stuff and selling this stuff is because there's a market for it. Summary, we looked at accounting for natural resources, we looked at the importance of those natural resources, and we looked at the regulation. And if I can hold you for 2 seconds. 6 is a cost-based standard. 141 is a fair value standard. We will be looking at fair value standards as we move through this course. There's argument that the regulators are looking to try to change more things into fair value accounting. On the flip side, there's a lot of pushback saying fair value accounting actually exacerbated the financial crisis. We'll look at why that is the case or why possibly that was the case when we do financial instruments after the exams. And that is me done. For those coming up to 7:30, I will see you there in a few moments' time. For the rest of you, have a good night, have a good weekend, and I'll see you next week.